Let's now quickly revise the topic of Introduction to Accounting Standards. Before we learn the word accounting standards, we need to know what we mean when we use the word generally accepted accounting principles. Generally accepted accounting principles are there in every country. These are what are issued as accounting standards by that country's regulating authority, or what are not issued as accounting standards but are followed by the people of that country very strongly. So generally accepted accounting principles are authoritative standards or commonly accepted ways which the people of that country follow for recording and reporting their accounting information. In our country, generally accepted accounting principles which are authoritative, meaning issued by the regulatory body, are two. One is accounting standards, the other one is Indian accounting standards. Why do we have two? We initially had only accounting standards, but to meet the global pressure, to meet the reporting standards, what is globally followed, we have started converging with IFRS, implementing IFRS, which is global generally accepted accounting principles, in the Indianized way, that is IND AS. Right now, accounting standards is followed by non-corporate entities, and few corporate entities have been following IND AS based on the regulatory requirements, which I'll teach this to you in the little later part of the same video. So all the non-corporates follow accounting standards. Corporates, some follow IND AS, some follow AS. And IND AS is Indian version of IFRS, which is International Financial Reporting Standards. What do we mean when we say accounting standards? Accounting standards are written policy documents. These can be issued by three. One, government. Two, expert accounting body. Three, other regulatory body. Government is like MCA, Ministry of Corporate Affairs. When I use the word expert accounting body, I mean accounting standard board. And when I say any other regulatory body, any other body which is created time to time will also have the power to issue accounting standards. Whenever they want to issue accounting standards, they cover four important aspects: RMPT, recognition, measurement, presentation, and disclosure. We remember this in a really fun way, which goes like Akshay Kumar doing Sing is King, followed by Shah Rukh Khan's ideal step. Then you do Disco Diwani and then match up the entire scene. It goes like accounting standards are issued by government, expert accounting body, or other regulatory body, covering the aspects of recognition, measurement, presentation, and disclosure. And whenever they issue these are applicable for recording all the transactions and events as a normal preparation of accounting and also preparation of financial statements. Why do we issue accounting standards? We issue accounting standards because globally, say even in national way, people don't have standardization, people don't have uniformity, no comparison, no reliability. So these are the problems that people will face in preparation of accounting. Everyone follows different accounting policies. To bring them all to one place, there is one reporting standard issued which says this you also follow, I will also follow. All of us will follow one, so that the financial statements what are prepared based on this are uniform, are standard, are reliable, and are also comparable. So the objective of issuing accounting standards is to bring in comparability, to bring in uniformity, to bring in standardization, and to increase reliability on the financial statements. What is the process of setting? You identify the area where there are a lot of accounting policies: goodwill valuation, fixed assets valuation, inventory valuation, recognition of provision. These are the areas where there can be different methods, different varieties, different policies. You identify the problem area. You create one study group to study this. They'll come out with one exposure draft, possible solution. That possible solution will be given to different bodies for review, like SEBI, RBI, SBI also will review, big industrialists, ICI if it is issued by any other body, or ICWA, that cost works accountant or cost and management accountants of India, ICSI. They'll issue to all these bodies. Everyone will give their reviews, and then they will tell what is okay, what is not okay. Once that is done, that changes will be made. Then they'll give it to public domain for people to publicly give their comment and opinion, which if it is found valid, it will be considered and the final draft will be issued, and that becomes accounting standard. That is the standard setting process. And standards in our country, in India, are issued by MCA, Ministry of Corporate Affairs, that is by Companies Act. These are applicable for companies. But for non-corporate entities, MCA cannot issue accounting standards. Their ICAI's accounting standard board comes into picture. Accounting Standard Board of ICI will issue accounting standard for non-corporates, and MCA will issue accounting standards for corporates. Both are same. There is no difference. And the drawback of accounting standards is it cannot override law. It has to be within the jurisdiction of. So we have so far discussed accounting standards, IND AS and IFRS. Everything looks similar, but has its own differences. Now let's see the global part after we saw the Indian side of. Why are we going to converge with IFRS and follow IND AS? What was the need? We had our own accounting standards. Why was the need for IND AS to be, I would say, propagated or to be brought into force? This is because whenever you seek investment from global companies, or whenever you invite companies from outside India to come do business in India, you want to help them understand again as to what are the reporting requirements of India. So they need to know reporting standards of India and they need to know reporting standards of their country. And both of them might not be same. There is again comparability issue, standardization issue, reliability issue, no uniformity. To bring in uniformity, reliability, standardization, comparability in the global outside, internationally, there was a body set up called as International Accounting Standard Committee, IASC. This started issuing international accounting standards, and this was supposed to be followed internationally, but it didn't become international till 2001. In 2001, 1st of April, this IASC was reformed into a new body called IASB, International Accounting Standard Board. This IASB started issuing same international accounting standards under new name called as IFRS, International Financial Reporting Standards. This got global acceptance and lot of countries started accepting it, including our friendly neighbor. But we kept on thinking, can we accept? Is it applicable? Is it completely our type? Then we understood that we cannot accept that IFRS vis-a-vis same to same. So we decided to make some changes. We added some Indian flavor to it, forgotten. We removed some things what we don't eat from that pizza or which is made international. So whatever we removed is carved out from IFRS. Whatever we removed is carved out. We removed it saying this is not applicable. I won't follow. Whatever we added, our version of it became carved in. So IFRS minus carve out plus carve in is IND AS. What is it? So ever since that we follow IND AS. That's how we've conversed with IFRS. We have conversed with IFRS, not fully adopted the IFRS. How is IFRS adopted in India? IFRS in the converged form in IND AS works like this. If it is IFRS 1, it becomes IND AS 101. If it is IFRS 2, it becomes IND AS 102 and vice versa. Similarly, the rest of the numbers are placed. And what is the roadmap for implementation? In 2015, 1st of April, on voluntary basis, Government of India told any company in India who's willing to become the lab rat, who's willing to comply with IND AS, you can do. In 1st of April 2016, it was no more voluntary. They made it mandatory. For whom is it mandatory? If the company is listed or it is in the process of getting listed, or its net worth is greater than 500 crores, or its parent, subsidiary, associate, joint venture is one of the two conditions, is fulfilling one of the two conditions, then you are supposed to mandatorily follow IND AS from 1st of April 2016. This is phase 1. In phase 2, that is starting from 1st of April 2017, they told mandatorily you are supposed to follow Indian accounting standards if you are listed or in the process of getting listed. However, exemption is there for if you are listed or in the process of listing in SME stock exchange. Small and medium enterprise stock exchange, if you are listed, IND AS is not applicable to you based on listing conditions. Based on other conditions, you can still become applicable or you can voluntarily take it up. Got it? When we say listed or in the process of listing for applicability of IND AS, it is other than SME enterprise. Yeah. So from 1st of April 2017, you are mandatorily supposed to come under IND AS if you are listed or in the process of listing in other than SME. Your net worth this time need not exceed 500. If it exceeds 500 crores, 250 crores also, okay, IND AS is still applicable. Or parent, subsidiary, associate or joint venture of any of the, for them it's mandatorily applicable. And this is introduction to accounting standard with the topic of IND AS.